As an operator for the majority of my career, I thought private equity had always been a thing. But in reality, private equity really came to its current form in the mid 90s. Can you talk a little bit about how private equity evolved and what purpose it really serves to help business owners release capital, unleash some wealth, and then also help companies grow?
Yeah, that's a great question. I mean, the original, you know, private equity today is more about strategy and helping business owners and families grow their businesses with we call it other people's money. Back in the early days, in the early '90s, when KKR and some of the firms first started, it was all about financial engineering, and the sum of the parts being worth more than the whole enterprise, and that really has changed over the last 10, 15 years. It's all about strategic vision, helping the founders put the right KPIs in place, put the right, players on the team, and helping the current management, from their experience, put the right strategies to work that are going to help them grow, 50 to 100% over the next 3 to 5 years. So private equity now is much more of a partner than an owner. And a vast majority of the deals that we're involved with, the private equity firm, after the first 90 to 120 days, is really just, part of the board, and helping from a vision standpoint, and, putting the right parameters in place on a day-to-day basis. So a lot less scary than it was 20 years ago when I did my first IPO in 2000, and then I did a private equity deal in '06. You saw the private equity firms that were more about financial engineering really got annihilated during the '08, '09 recession. And the firms that lasted and are really flourishing today, like the Riverside Company and Princeton Equity and Susquehanna, and those firms are really all about helping current management grow the business and not replace management and not change the strategy. So that's where our process, where we narrow it down to 8 final private equity firm, really self-selects and aligns management with the potential buyers. So by the time we get to LOI stage, everyone's pretty aligned with where they think the business is going to go.
All right, let's deconstruct something you said. You said that they were people that were looking at it for the sum of the parts, right? So was it RJ Reynolds that was featured in Barbarians at the Gate, where there was a leverage buyout, and then they wanted to deconstruct the company, buy it at a low price, deconstruct it, sell it for a sum of its parts, and then basically make money on that. And it was called Barbarians at the Gate, and how they tried to hold them off. I don't know. It was a big, thick book. I never got to the end of it, so I don't know what happened there. But,
that really, especially in the sub 500 million prize value, we don't see anyone, especially in the franchise industry. I mean, no private equity firm is paying 10 to 15 times cash flow to deconstruct the company. It's all about growth. It's all about strategic fit. And it's all about how can that private equity firm add value from a marketing standpoint, from a finance perspective. How can they assist the current management team in getting that company to the next level? So, the Barbarian at the Gates and those type of episodes in private equity, they still do exist, just not, especially not in the franchise space.
Right. And also the antagonist or protagonist in Pretty Woman.
Yeah. No one's buying Blue Star Airlines anymore to separate it out. So it's those are great movie lines and movie plots, but that's no longer the current private equity environment. So.
Great. When I think about private equity, I kind of think about it as a ladder, right? You've got some people or some firms that are going to operate in the lower market, and they're going to have a certain size fund. They're going to invest in certain size businesses, maybe a platform company that's healthy, and maybe they're willing to pay a good multiple for it. But then their goal is really through organic growth through strategic partnerships and through accretive acquisitions to take that business and add on to it, and basically 1+1 = 4 or 5. Because when you move it up to the middle market, and there's funds that say, I can't write a check less than $30 or $50 million. Those companies are going to be writing bigger checks. And ultimately, the higher the EBITDA is, or the cash flow minus certain things, then the larger the multiple generally is. So it's kind of this game of taking an asset and then figuring out how to enhance the asset for its benefit and for the benefit of any of the other assets that are put with it. And that's how extra capital is generated. And then, of course, there's always a bigger fish that if you can build it in the middle market and you build it to a $50 or $100 million EBITDA business, then there's going to be somebody else at that level that's looking to make those types of investments. Is that something that most business owners that you engage with understand the concept of, or is it even important for them to do so?
It's part of when we take on a new client and during the process of onboarding a new mandate, we really spend a lot of time with the client trying to understand, do they want to be the platform? Do they want to be part of a platform? If you become part of a platform like Empower Brands or Neighborly or Authority Brands in the franchise space, or an Unleash Brands, that's a different second bite of the apple. Our client's going to get, shares or roll forward into a diversified portfolio of franchisors versus just being, a single franchisor investment. So there's a lot of benefits to becoming part of what we call a franchisor aggregator. But there's also, you're diversifying your upside and your risk by, your firm isn't going to be the sole determiner of future value on the next exit. So, but there's been, the great thing about the franchisor space is, even KKR owns Neighborly now. And, 10 years ago, KKR had no interest in the franchisor space. So you're seeing the largest of the large private equity firms invest in franchising. Blackstone has an effort now. They've made some big acquisitions in the franchisor space. And, so you've seen, all the way from the smallest private equity independent sponsors all the way up to the Blackstones and the KKR and the Susquehannas, putting real money behind the franchise industry.
What is it about the franchise model that they like so much?
Predictability. We always term it internally is, a lot of our clients are recession resistant and pandemic resistant. So we have a lot of clients who did very well during the 08, 09, 2010 recession because corporate refugees, as they got laid off at the, some of the big GE and some of the big firms, they went out and bought franchises in residential services business, lower initial cost franchises, and bought themselves new jobs, making $150,000 to $250,000 a year. So we've been able to prove to the private equity industry that, through the recession of 08 to 2010, a lot of our clients did extremely well. And then during the pandemic, once again, franchisors did extremely well, excluding restaurants, but franchisors in residential services specifically did incredibly well during the pandemic because more people were staying homes and they wanted to spend money on new fences, new roofs, new siding, new carpets. Franchisors have proven time and time again to have high predictability of royalty streams and future cash flow. And there's very low CapEx at the franchisor level. So your free cash flow from EBITDA to free cash flow is a very high conversion. And so the ability to service debt, and the lenders love franchisors. So it's really proven to be a great industry for private equity to get behind.
If I'm an operator listening to this, you've just started speaking the language of finance. And you helped us, I believe we were one of your first deals in franchising with my business at Vaniclean back in 2018 through the year, and then closing January 1st, 2019. And what was apparent to me that was not apparent before is that finance is really a foreign language. And no matter how intently I listened, if I didn't have the underlying fundamentals of finance, how the businesses are being evaluated, what the ratios are, how private equity firms evaluate risk inside of a brand, what they give weighted credit to, what they take credit away from, and really, navigating that to your extent. If you don't speak the foreign language of finance and you're an operator that's been doing painting or restoration or one of these things, and you're going to get into a room and think that it's like dropping in Portugal and you haven't spoken a word of Spanish your entire life. You know that the octopus is great. You love the coasts. I mean, there's things that, you'll recognize words occasionally like bathroom, but at the end of the day, you don't have a chance. So, talk to me a little bit about, some of the do's and don'ts. If you are a franchisor, or if you're a direct business, or if you're even a franchisee, which I'm going to want to talk to about what's happening in the boxes, as we say, in the franchise industry, going through the brands into the boxes and the consolidation that's happening there. But I mean, right off the bat, what are some of the do's and don'ts that you can give value to our listeners here? Because we have a huge audience, I've found out, in franchising and with brands and with business owners. So, what do we stay away from?
Well, one thing is I would never share your internal financials with a private equity suitor before we've actually evaluated them and gone through and cleaned them up. And, that's one of the number one mistakes we see is, we'll take on a client, we'll put together their new P&L that includes adjustments for one-time expenses. And say you hired a new CFO and you spent $100,000 with the recruiting firm to find the CFO. That's a non-ongoing operational expense that we eliminate in the P&L that we put together. And then two, we create a maturity curve on sold but not yet open and locations that have been open less than, let's say, a 2 to 3 year maturity curve. And we'll run that out and create an embedded EBITDA based on all the locations sold but not yet to maturity levels. So when you hear a franchisor got 20 times EBITDA, it's probably because it's 20 times their initial EBITDA, but the buyer or the private equity firm has paid 12 times EBITDA based on the pro forma adjusted EBITDA that we've presented to them. So you just got to be very careful. It's very hard for us to convince a private equity firm that's already seen that you're at 5 million of EBITDA, that you're now at 7.5 once we're done all of our work. It's much better off if they've never seen your internal financials at 5. So that's a big mistake. And then, I think making sure that you have good legal advice. We see too many emerging franchisors trying to save money on their first FDD and franchise agreements and not really spending the time and effort and money to get their FDD and their documents right up front, and then being too open to making changes to the franchise agreement just to get a franchise fee, on those first 10 to 20 units. We see a lot of messy franchise agreements in the initial, the first 20 units of most systems because they're desperate or eager to start making progress on the franchise development side.
So many mistakes are made. As you're aware, I was a participant in building a franchise sales organization called Frandevco. And through the course of that, that was my COVID project, right? I had sold my business and you had all day to be on Zoom. And I was on Zoom 12 hours a day during COVID. It was unbelievable, but interviewing companies for representation by our franchise sales organization. And more often than not, they had had some success. Their program may have stalled out. So they're trying to find a solution to relaunch or reinvigorate their franchise sales. And they would send us their documents, and they had given the entire state of Texas away to a franchisor, their territory model. I believe I have seen some franchisors basically cap their outcome to 50% or even 25% what it could have been because of the construction of their program. And then unfortunately they had success. So now they had 20 or 30 or 40 franchise owners out there all the good territory was gone. They didn't have performance incentives in there, like I say, or things that would force consolidation or encourage people to spend the right thing. So you look at these documents, and now they've got to reel it back in, but that's really not that easy in franchising. A deal's a deal, and they've got to go through a cycle of renewals and stuff. So they took what could have been a 5 to 7 year journey, and they've just made it a 12 to 15 year journey, really, to get the value out of it. And I'm not trying to over dramatize it, but it's true. I mean, the genius attacks that people have in creating their franchise program without getting proper guidance or strategic disclosure documents. You can get a legal disclosure document from a lot of franchise attorneys, but they're not necessarily going to be strategic. And I think at Homefront Brands, one of the things we did was, before we ever went to market, we brought in the chief legal officer who had been at ServiceMaster, he'd been at ServPro, he'd been at Valvoline, and his property service experience really helped us. There was things that we were able to put into our documents, I think, for the benefits of the franchisees and the franchisor, that I just didn't have visibility into. So, really good, really tight. They've been, they've held up, and they've aged extremely well. And I think, but again, this was my second time around, or probably more like my 10th time around by then, with all the brands that I helped or participated in between 2019 and 22. But for many people, it's like, I think that's a critical advice, is if you're still young in your franchise journey, or if it's just starting, proper strategic advice from somebody who's actually built a brand or actually helped somebody sell the brands. Yep. Because there's lots of people giving advice out there, but I will tell you, probably 95% of them are going to take some money from you and give you, some sort of a templated deal. So it's hard. It's actually hard to get the good advice early in franchising. I think it's one of the challenges in our industry.
Yeah. Far too many brands, have made very poor decisions when it comes to area developer agreements. And just to get some quick cash in the first couple of years of the franchisor journey, and then those area developers, sit on them and don't do anything to produce additional royalties. And, then you got a great brand sitting there, and, no ability to push new locations or new territories being sold in those areas. And it just really is a limiting factor, and it does hurt the future enterprise value of those brands. So I'm always very consistent when I'm speaking to emerging franchisors about, getting the territory or protected territory on a 4-wall location franchise. Make sure you're getting that sizing correct, because you don't want to sell out all the good white space and not get the royalty benefits from that. So